The last time we saw a candle close like this on the monthly, bad things happened to stock markets. Hello, ladies and gentlemen, and welcome back. Today we discuss stocks, commodities, and cryptos and deep dive into the month of March, which we're now in. What happens in markets around the world tends to be a dip into a potential recovery. So how bad are things going to get? Today we discuss that topic. Along with that, we've got a data read that we haven't seen in quite some time, and some of the stats are pretty extreme. So let's discuss all of the things going on in the markets right now and also whether fear is about to return in a big way. All right, well, let's get into today's storylines. And of course, we'll be covering the macro news, lead indicators, and hottest charts for you in today's session. But I want to just give a quick shout out to the US dollar and our discussions on it in the previous video. We obviously talked about the demand structure that was here. We saw the market swing the lows, which was our suspected kind of move, and we've now had it break above our closed levels. So what this means is that the current fear trade that's been so prevalent through the market over the last kind of 2 weeks is currently looking kind of like it's back on. The stock market went down, which we'll talk about later on today's video, and the US dollar went up, one of the fear hedges that a lot of people look at. So does this mean that now dips are going to be bought with buy demand? Well, it's certainly one of the lead case scenarios and something that we're looking at. So remember to follow @FXEvolution in the description down below if you're interested in some of our charts. We will be sharing them every couple of days, just in terms of key levels that you could be watching, along with kind of like a companion to this daily show that we produce here on YouTube. Make sure to subscribe if you haven't already. Let's move over to the most significant decline in history, the topic of today's storyline. Yeah, we've seen two massive switches. Not only did we have one of the most significant increases in history in natural gas, but then we had the most significant decline ever, negative 80% on the contract size. And over here on this chart, what you'll notice is we saw a historic plunge in spreads. Basically, we hit this negative 60% in the 1-year future spread as a percent of the first contract price. And we also, in the same 12-month period, hit a historical high, plus 40. Now, whenever we hit these areas or reach these zones, we basically see incredibly big returns each way. When we had above 40, I'm on record, of course, hating on oil and natural gas last year before the winter in the Northern Hemisphere, because I kind of knew these stats were playing out. And of course, stats along with our technical analysis can be quite strong. Annualized returns, negative 99.9%. Well, that's pretty much what happened. And percentage of the time it was going to be above 40 or below 60 is only 1% of the time. So just like everything at the moment in 2020 to 2023, we're witnessing history again. Now, what's more disturbing is when you look at the percentages, 6,722.4% annualized return when it's on the bottom. That doesn't mean go out, buy it, go crazy, of course. It's only a statistic. But I just thought I'd share this with you because it's so significant, some of the switches we've seen going on right now. Now, for anyone that hasn't traded futures contracts before, please be aware there are rolls, there are significant risks in this market, and it's called the Widowmaker for a reason. It moves incredibly fast and very, very quickly. But I thought this was a very big difference. So we've now seen a significant reversal in future spread price. We've actually got some indications that show us that potentially buyers have recommitted to this market. It makes sense. It was in an extreme zone of capitulation. But what about the rest of the things that are going on right now? Well, here are some reads when we tend to get these in the past. So this is, of course, just using statistics back from kind of the last 20 years. And this is not the first time we've seen something like this. We've seen it before, hence why we have some statistics that go around it. Now, you'll notice down here, the stats are pretty impressive. I mean, basically, it says 100% of the time markets have been up from that point. Does that mean that it's going to happen like that again? Probably not. I mean, every time is a little bit different, but you'll notice even here when you get these reads, although it can get shaky for a little period, maybe 1 to 2 weeks, in general, it can detail the base and the thrust is kind of coming through now towards that buy side. So it's an exciting time in markets and certainly one where you could be looking at instruments outside of the stock market, but you've got to be very, very careful with your risk management. We'll look at the chart later on today's video along with everything else. Let's get into, though, our main thought processes behind the rally and why the rally that's in the stock markets right now could be a little bit dodgy. So the first one has to be consumer spending. We've talked about this several times. I'll gloss over it, but I want to make sure that anyone that's a new viewer can see this. So we know that, of course, realistically, the American consumer, along with pretty much the worldwide consumer, is feeling pretty strong right now. We've seen an increase in liquidity into the markets as well. And we also know that people tend to be spending right now on debt. And this debt is going to be paid at a higher interest rate. So a lot of people don't really think about the risks that they're putting on top of themselves. Basically, we became accustomed to spending a certain amount in 2020, and that's basically continued to move on, which has created a sticky inflation problem for the Federal Reserve. So they're going to have to go higher, and it's a nightmare in some ways what they've done here. We also know that global liquidity has already started to show its bottoming process, which is something that we have to now keep a massive eye on it. Now, I haven't updated this chart yet, but I will be talking about it. I can confirm one thing. Global liquidity has tightened over the last 2 weeks. So effectively, partially why I believe we're returning back down to these lows has been that liquidity has actually started to decline in 2023. So we've seen effectively most central banks outside of pretty much China saying, okay, we need to tighten up here a little bit. We've got issues and we've got sticky inflation. Now, we know that the markets have been following a non-recession path. I always go with the bonds market is usually correct. And at the moment, the bonds market is still telling us that there is a recession coming. The problem is the bonds market is incredibly early. We have posted on this channel before that before recessions, we tend to see, of course, a spike in unemployment. We tend to see it come off its lows. That has not happened yet. Next week, we get the jobs numbers out of the US. Will they be weaker than the January report, which was basically wild? Well, we'll find out soon enough, and we know that the markets were getting a little bit optimistic. So if you're a believer in a recession, which is more likely to come more like Q3 to even Q1 of 2024 at this stage, or even a bit later than that, then you need to remember timing is everything. There's still a real case to say that markets may come down in March, but still may rally through April into May and then potentially become more kangaroo-y into the end of the year as we see the next earnings results. What can we be sure of? Well, one thing's for sure. If we look at every other time, at least statistically, when the Fed has tightened, they have broken something. Now, to different degrees, they break different things in the system. These are all the times they broke something after raising rates. What we do know, though, is that we've gone from a historically low rate to a historically higher rate faster than ever before. So it takes time for that to catch up. We also have zombie companies throughout the US and other countries in the world that are currently being propped basically by central banks in the world through the liquidity and, of course, the bonds. That's starting to dry up as well. So be careful of what is actually going on behind. I know there's a lot of bull storylines. I'm not here to spread too much FUD on top of that. I am bullish. Optimism does pay overall, but timing is everything. So we need to be looking at it from a trading perspective and investing perspective, and of course, just like as much realism as we can put into these charts. Let's move over to annualized seasonality. It helped us, of course, define the middle of February. At the moment, we place ourselves at the start of March, which is usually kind of like a little sideways and then it drops off. And we know that historically there are good runs from the back end, kind of like the 15th to the 20th of March onwards into April. Will it be like that again this year? We did see a nice rally in the previous years into, of course, April, and then we saw a dump off in April. So we've got to be very, very careful of using seasonality. Again, it is a tool along with the technical analysis of our charts. Volatility, does that tend to spike? Well, yes, it does. Q1 and Q3 are well-known periods of volatility spiking. This means usually the VIX is increasing. However, at the moment, we've obviously got the 0 day to expiry options, which kind of ruining the VIX in some ways. So I'm going to take it off the chart for the time being and bring it back when it's necessary. However, we do know that volatility tends to spike around the same time. What about the Wall Street players? Are they moving defensive? Well, this is where the disturbing component comes into it. Generally, you would expect that they'd move defensive over the last kind of month leading into a fall. They didn't really do that. In fact, in the last 24 hours, staples, healthcare, and utilities, and even energy were some of the worst performers on the session. So in comparison, we saw things like consumer discretionary doing a lot better. Just before we get into the charts, I want to remind everybody that March will be the first month that we put out our data kind of free sheet. So if you're interested in that, just grab over here onto our link tree down below, 3 free trading cheat sheets, sign up for it, and I'll send you guys a data report when we get it out during March. If you also, while you're there, follow us on the other socials if you're interested. Let's move over now to the charts though, because I want to get stuck into this one. I'm actually pretty excited about some of the key levels we're coming up to. US 2-year, that's approaching critical zones. It was a level that we've talked about many times that we thought may stop yields. And we know that we've got that 5 and a bit percent 2-year that is really critical. So at the moment, the 2 years getting nasty. It's actually close now to where we set alerts the other day to say, okay, markets are not going to like this. And this could have created an explosion in US yields that then might cause, of course, markets to come down. So effectively, we know that we're at a critical point, and we're probably approaching an area where you need to say, well, how much higher can it really go without breaking something? 6.5% would be incredible. Over here, this 5.5%, I could see it kind of going up to that and then starting to drop off. We do have to hope that the Federal Reserve has this in hand, because if they don't, unfortunately, a lot of people are going to suffer. And of course, markets will get a lot worse than even pretty much most people's worst case scenarios if inflation goes so long that we have to push yields somewhere in the vicinity of 7+%. That would be absolutely breaking the system. Bad things would happen. Let's hope that doesn't happen though. HYG, this is the high yield junk bonds. They're kind of stabilized. So that's interesting to see bonds stabilizing while the market's falling off. Usually means that the bonds market's not as concerned. So if you continue to see, let's say HYG going up and the stock market going down, it's probably an early warning sign that we might be going into that data, which is that March kind of drop into a nice little bit of a recovery, and we should be looking for the recovery signs actually, at least in the short term. If we move over to treasuries, we know they're in kind of that area of interest. So treasuries are in an area of interest at the same time that the US 2-year is approaching those highs and approaching some of the critical zones. It's hard to see the US 2-year going over 5.5% by too much. So I think that this treasury kind of play is going to be very interesting. Obviously, it's based on the long-term yields, but they've been climbing at the same time. How bad could treasuries get? Well, realistically, I still believe this green box down here is possible for treasuries. However, you usually find bonds go up in 2 times. And I've said this many times before. They go up when everyone hates them, which I still remember was 2019 into 20. Everybody hated bonds so much. So 18, 19 was a great time to buy bonds. And when people need them. If a recession looks like it's on the cards, then you'll find that people will want treasuries, especially big fund managers. And remember, positioning is something that's very important here. So let's move over to the US dollar and how that's been looking on the charts. So we saw via the Twitter thread that I posted, effectively, we had a switch. We had a movement up that broke above this key critical supply zone, which we knew was there over the last 24 hours. The market's now closed above that area, and it looks like at this stage, we know 2-hour trend is still up, and we know 4-hour trend is still up. It came off our 105.25 zone perfectly. That's perfect. That's exactly what we expected. It pulled back to the first level of demand, and it's finding buyers. So what does this tell us about the stock market? Well, it means that although the stock market might rally a little bit while this is dropping off, it could be kind of bad for stocks. And we saw that with the monthly closure. You know, we've been expecting rallies here around these levels for stocks, and we're getting the rally through the session, but by the end of it, we're selling into the close, and we'll look at that very soon. So dollar index looking okay on the charts. Gold is still relatively weak. It had a bit of a switch on the bottom here. So while it might pull back down, overall gold's in what I would call a neutral zone. It's still 2-hour, 4-hour short. So ultimately the market is still towards the negative side. I am a bull on gold. I'm just not a bull until we see the right signs in terms of the medium term. Remember, I was super bullish back in November all the way to the end of January. Then I said, no more for me. Okay, I was done. It hit some critical levels. We were happy with that. Now we're looking for signs of switch. And I don't think you have enough edge on gold at the moment. It's a very tough trade because the yield stuff is in the high interest rates. Gold hates that. So it's pricing in a lot of those high interest rates for longer, and it doesn't like them very much. Now, copper's moved back up. It's kind of in a critical zone. We'll continue to watch copper. Obviously, I am net kind of thinking towards the negative side on copper. But at this stage, we're back at kind of like a critical zone, and I'm looking to see whether it finds weakness in the next 24 hours, kind of hoping it will. Now we move over to the topic of today's discussion, which is obviously natural gas, the widowmaker itself. Yeah, it hit those critical lows. We've seen it do this a few times. The weekly is probably my biggest one. The switch on the weekly was a big deal. It now moved above 270, which is interesting. I still think it could pull back further, but it depends on what your plan is here for it. We've seen the stats. The stats look really positive. The way Wall Street, or the way that really markets can now stuff around with this, could be pretty extreme. They could obviously push it up, get it right back down to deeper pullback, and then allow it through. Another scenario is they do something like this and build an accumulation story on it. You're trying to stop a freight train. So has it hit criticals? Absolutely. Have data points like this in the past been pretty positive? Yes, but it's just data. It's not a solicitation to buy or do anything, guys. You've got to be careful out there. There are a lot of risks with this, and I just have to keep reiterating that. And we know that we've got a little breakout past the 270. So that kind of proves that, yeah, look, it looks like, at least temporarily, the market is liking what it's doing. And it's made a big switch. And I'm sure a lot of people got, unfortunately, stopped out down here. You'll notice also it's little inverse head and shoulders down there that boosted in. But here, I'd like to see some weakness back into kind of like that 240 line, and then find out whether the buyers recommit there. And of course, if they did do this, then that would be a larger inverse head and shoulders, which is a decent pattern on top of everything that we have at this stage. So natural gas, certainly a risky one, but interesting. Let's move over to US oil. US oil stuck in the middle, so effectively not very interesting at all. That's why we stopped covering it for the time being. I have alerts. I'll bring it back if necessary. At this stage, it's boring as boring can be. What about Tesla though? Well, it wasn't really a great 24 hours. It wasn't really a bad 24 hours. We know that people are hyper bullish on this stock. I think it's in consolidation. So what that really means is that we had a mega run. If Wall Street is dumping it, they'll dump it in a certain way. Remember, this could be a buyer's climax. This could be basically a selling rally. This could be a UT, and we could be going for one more UTAD. But overall, it looks like we could be in distribution. So I think that you've got to be very careful around these points. If we do get breakouts to the downside, where do we end up going? Well, I still think this gap needs to be filled, which is that 145 kind of zone. I'm fairly confident that will occur, but just be signed that signs of a Wyckoff distribution are starting to appear. You could make an argument that we are still in accumulation. This is an AI trade though, along with other things. It's also a trade into the hype story of the current events that are going on with Tesla. So be careful, because it has all of the starting signs of a Wyckoff distribution, and we need to be careful about that. In terms of edge over the next 24 hours, if the market does end up kind of opening down, that would create kind of a counter island reversal to what we've seen so far. So we had gap up, consolidation. If we gap down, could have follow through selling. So be careful there. At this stage, we're stuck in the middle of the zone, and we're looking for the next evidence. And at this point, we don't have a huge amount of evidence outside of that. If we look at the options market, you can see what's happening. Heaps of people trying to buy 200, heaps of people trying to buy 220. I think it's misguided, the trade. Obviously, everyone knows the trade now. So it's one of those points where if you want to make the most amount of money in your Wall Street, what do? Consolidate and sell into retail, really. I mean, that would be the best thing for them to do, or to expire all the options and then allow it through. So this is mostly a retail play. You can tell because the open interest volume amount is so low. Let's move over to NVIDIA, another one of the AI blockbusters. What's it doing? Again, consolidating after a beautiful gap up. Now we've created this potential island. Do we get a gap down? That could be an interesting one for day traders that are kind of feeling negative against this thing. At this stage, we have no sign of doing that. But what if we do open with a gap down? Will we get the follow through? Certainly an interesting one here on the charts. And NVIDIA's push to that extreme level would have taken a lot of stop losses as well up here, because people would have seen these tweezers and gone negative. And if you weren't using a correct risk management or options or something like that, you would have been stopped out. So remember, it's probably hunted quite a lot of traders out there, maybe even you that's watching right now. It's unfortunate, but it's what happens. If we move over to Apple, 2 rejection wick style candles, 2 bad looking closes, and an island reversal to the upside. Geez, I tell you what, it's the market loves giving some weird signals at the moment, and it's been in some ways a great 2 months and in some ways a pretty tough 2 months. We end up the market at the levels I feel like we should be, but the Apple trade and other ones, we're getting like kind of islands versus islands. So you've got to be a little bit careful here. I would say neutral is the way to go with it. Unfortunately, there's not really too many strong cases. You could say the daily's really weak. You could say the island is strong. And you could say we're at a critical level for stocks, which I'd agree with. If we move over to the XJO, which is the Australian market, so we'll go through all of the markets now, including the US ones. Let's take a look at the ASX market. I still think it's weak. It's probably going to have a little rally into a dump. But yeah, I'm not convinced by the ASX at this stage. The Australian market does well in inflation, which is why it's back at its kind of all-time highs, or was. But ultimately, we're seeing copper weakness. That's not great for the Australian market. Let's move over to some of our ratio-based trades. We've got the Qs versus the SPY. Now, the Qs are holding up better than you'd think. So the NASDAQ high kind of growth stocks are actually holding up pretty nicely in all of this inflation discussion, which is interesting because usually you would see as a proportional, the tech stocks going down and SPY going up. So therefore this ratio should be declining. This is the trend line that I'm watching for 2023. I think it's a big one, this ratio trade. Obviously Qs have led for years. So we have to think of that as kind of being a potential of a new market bull run. And we'll be watching that as much as closely as possible. Here is the American consumer discretionary versus staples. Now you'd think again that as we're going down in this market, that we would see this go down as well. It's not really, it's holding its ground. So American consumer stocks, they're not weakening as much as you would expect, which is strange. And I'd say this sell-off is very strange in that action. It's not the normal way that it would work. Usually you'd see more rotation from the street. Over on the Dow, it's at the kind of critical support lows, which you can definitely see why it would be there. And if we start looking at the Qs, this is where things get a little bit interesting. So look at this monthly wick rejection. It's nasty. Now, we've seen these before, and what's important is it doesn't mean that it's going to have incredible follow through, but what it does generally mean is there is some follow through at some point. Monthlies don't close for no reason. So when you get a monthly close and they tend to be these rejection weeks, which you'll notice don't happen very often. Like when was the last time we even got one? Over here, I guess. And that was actually a doji. We don't really get too many of these. So this is a very nasty looking chart. I mean, it looks horrible. If we go down to the weekly, you can see the weakness of the wicks. You can see where we are right now. And you notice the wicks are important. I mean, we get these reversals and they tend to, create decent rallies. So we're going into a pretty weak month, being March at the start anyway. And we have a daily that's completely confused. I mean, what is this? I laugh because it's really bizarre. I mean, it's one of those times where you look at a chart and you go, what is going on? Okay, makes sense. All right, interesting. A lot of false kind of signals here. And then you get into this thing, which is just like a Gapapalooza fest of all sorts of wicks and dojis and considerations. I mean, it's clearly confused itself what it wants to do. We'll move over to the futures. Here's the futures market. We'll go to the 2 hour. And we've got some key levels that we believe, we should be looking at. So we've got that previous low over here, which is an interesting swing. And we have this high over here. Now, I think this high is going to coincide with the S&P 500 at 40.27. And that's going to be an absolute critical bust break. If that happens, bulls are back in town. At this stage, we can't ascertain that is occurring. We don't know that. So the bulls back in town story is not happening just yet. If we get further closures below though, let's say this level down here, then we're probably going all the way back into those 11.6s for the NASDAQ. As you know, on this channel, I like to use the S&P 500. So let's have a look. So we did manage to fill a few things. We managed to fill the gap that was here, which I will delete. So that's now filled. We do have still that island reversal towards the bull side, which is still in play because technically the stop would be underneath the low. If we breach below this low and close, well, further weakness will come. I mean, if markets rally at that point, you've got to think there's sell demand in there. And I think we could be moving towards maybe even lower than 38.80, which is my original plan, 38.80. We could be going back into this area should we bust below. And I think 38.26 is a pretty critical zone that we'll be looking at in subsequent weeks, if necessary, off the jobs numbers, etc., if the market continues to sell off. Let's also just discuss this point. I want to bring up monthly pivots, which we'll see open in the next day. So make sure to subscribe because we'll follow along with that story. I would like to get the monthly pivots, set them up and see whether we can get some coinciding confluence stacked zones, because that's what we're looking for in the month of March. We need to be very precise with our levels as much as we can be, just like we had the extreme zones in the previous month of February, where we that this level here was absolutely critical and we saw a build towards the short. We need to see where there might be a build towards the long, because although you might think, wow, the market's just going to destroy itself, there's still a ton of options that are expiring third week of March. So remember, third week of March, there's too many puts in the system, guys. It's going to be very difficult for them to push it through. We'll look at that in a second. Here's the current state of the futures market. So we know that we've got supply up here, critical zone, okay? On the smaller time frames. No doubt that's critical. You could also make a case now for this 4,000 being critical for bears, because we saw them sell it once, twice, and then 3 times. Now, I'm not going to say I didn't do this. There was a pretty decent little pullback long that happened in the previous open. So we actually saw the markets tap this early. So this is before the session. You can see the volume with the session. Session pulled back, nice little long into the open, but this is where the problem lied. We needed a close above this 4K zone, and we just didn't get it. With no close above the 4K zone, unfortunately, these had to be broken even, and then the market just went, no, I'm going to sell all day after that. So it was a nice rally in the morning, really consistent style trade, but by the end of the day, it was nasty. And you can see that this is what basically was happening on the futures market. We've sold wick, we've sold again wick, and then we find ourselves at these critical, most traded zones over the last kind of 12-month period. So we're at this super big zone and we're not seeing the buyers recommit. I mean, we know that 40.27 is key. At 40.27, we breach that. 40.80, 40.90 becomes an incredible possibility of technical analysis. You know, that's a really good equilibrium zone. But if we bust these lows again and close, specifically using the SPX, if we go down here and we look at these daily levels and we close below these, look at that close there, then all of a sudden we're opening up and exposing below 3900s, actually around that 3880, 3890 zone, and possibly even all of these unfilled gaps that I've now updated that were left behind back over at the start of December, or start of December into the start of January. So basically we've got seriously significant levels down here. I would be surprised if markets could get through that without finding buyers. There'll be buyers somewhere in there for sure. And at the moment we have a convoluted market where we only know 40.27 is a key zone for buyers, and that's certainly where the markets are looking towards. If we then refresh, and we'll refresh this now, the options expiration for the end of the week, we only have one significant level, and that's got to be the 390. 390 is so many puts there. I don't think markets would want to get through that point. We've got maximum pain sitting at 401, which is where the market would make the most amount of money if options all expired. But it's not a huge week. It's not the one that usually would use maximum pain on. For the 10th, you can see here where the puts are, again, 380 and 395. It really allows that storyline of further weakness in the market. But here's where it gets crazy. If we go to the 17th, whoa, hold on. How many puts do you want in the system, guys? So basically anything under 390 becomes very bad for the street to be paying off. So we've got weakness, it works pretty well with the data. We said this in the middle of Feb as well. We've got weakness potential that can lead into kind of like the 17th of March and then has to buy into that to try to make the most amount of money for the street. This is 3.3 million options all of a sudden. So there's a lot more at stake here in terms of written options in the markets. So we have a lot of 400 calls. You can see 400 is one of these critical levels. We also have 394s. I don't know why it's 394, 395s and 390s. And 390 seems to be the definitive factor. So even if we go down to those 380s and 375s, you would think there's some buying there to try to commit back into getting it above by the end of March or by the middle of March. So some critical levels coming up, very interesting times in the markets. I'm excited to follow them. 40.27, big key critical zone. And obviously if we keep dumping off here, we've got some good levels, and I'll build some complement stacks and bring them to you guys over the next coming days for those potential eventualities should we go down. Bitcoin versus the old US dollar, how's it going? It's stabilized, I guess, but it doesn't really look good or bad. Bitcoin still hasn't cracked our big key level. I tend to like to focus on the higher timeframes for Bitcoin. I just think it's easier. If Bitcoin moves through 25,200 and closes, then we move towards, my opinion, 30K. At this stage, it's hovering in the range. I'm interested in what happens here in terms of will buyers recommit. That could be the zone that you find if markets fall off further and hit those kind of 3880s, etc. on the stock market. And at this stage as well, Bitcoin is being propped by China liquidity, and you can't expect that to go away anytime soon. So Bitcoin seems to be stabilizing better than some would say. However, it doesn't look exceptionally strong or weak at this stage. We just know that the sellers love that 25.2 at this point. For the week ahead, more data coming out. ISM manufacturing PMI 10 a.m. New York time. Then we scroll through and we get ISM services PMI at 10 a.m. New York time on Friday. There's a lot to watch out there in the markets right now, guys. Make sure you stay on top of the markets. If you're interested, follow us over on the other social medias. Always help us out. You can join our private community, and remember to subscribe and smash that like button. Thanks so much for supporting us, and hopefully I'll be able to get more of these videos out earlier, especially for everyone on the East Coast. I know some of these come out pretty late. Thanks so much. Bye for now.